Hi everyone, my name is Nicolai Sivertsen. I work as an equity research analyst at DNB Markets and would like to welcome you to this Capital Link Deep Dive webinar series. In this series, we have the opportunity to be a part of a detailed discussion between myself and Dr. Loukas Barmparis, president of Safe Bulkers. I look forward to the discussion and have compiled an extensive list of questions for Loukas, covering Safe Bulkers' achievements, performance, objectives, and the dry bulk market. The DNB Markets Equity Research shipping team covers 31 listed shipping companies, where I, on the team, focus on the tanker, container, and dry bulk sector, including Safe Bulkers, on which we have a buy rating and USD 6.6 price target. Safe Bulkers operates a fleet of 44 dry bulk vessels that transport primarily coal, grain, and iron ore along worldwide shipping routes for some of the world's largest users of such services. Investing in environmental technologies and boosting fleet competitiveness is a key part of Safe Bulkers' strategy. Besides implementing a program for environmental upgrades on the existing fleet, the company is underway in a significant new building program. It recently took delivery of 3 new builds and expects the delivery of 9 more from Q2 23 until Q1 25. The company's common stock, Series C preferred stock, and Series D preferred stock are listed on the New York Stock Exchange. Before we begin our call, please note that this discussion is strictly for informational and educational purposes and should not be relied upon, and that this does not constitute an offer to buy or sell securities or investment advice or advice of any kind. Capital Link is the investor relations advisor to Safe Bulkers. So let us begin our discussion, and I think we should start out with what we think a lot of people are talking about. The dry bulk market is relatively soft at the moment, but how do you think this the current weakness compares in an historical context? And also, momentum looks to have turned recently. So do you believe this is supported by fundamentals and bound to continue?
Yes, hello to everyone. Yes, it's correct. The market has recently changed a bit, and we believe that in the following months it will gain some more momentum. Basically on the expectation of China's improving performance and the opening of the markets. Of course, we had this quite low, relatively low markets, which are also seasonal, as we all expect, because traditionally the market is quite weak in January, February. And also the market has been affected dramatically from the war in Ukraine, and the interest rates increases. Interest rates affect the demand for dry bulk commodities, for everything, but also for dry bulk commodities. The expected growth in dry bulk commodities is about 1%. For this year, the projected demand for dry bulk commodities is about 1%. We believe that, according to our analysis, that grains will grow a little bit faster at about 4%. We have the problems still in the Black Sea. China probably will pick up gradually, a little bit later than what we expected, but this will improve the demand for steel. For the coal, we had a mild winter, so the needs were a little bit lower, but I believe that we need to live with this 1% overall growth during 2023.
And as a follow-up question to this, shares of Safe Bulkers are up some 50% since end September, and it seems the recent share development has outperformed peers. Can you talk a bit about what has driven the recent upturn for the share, especially in light of dry bulk rates still being quite low or having been quite low, and especially relative to your closest peers?
Yes, look, I think that our share price is what it is. It is basically demand supply for buying our shares, and we think that our performance was not as our peers in the past, because we have let's say a reasonable and but also restrictive dividend policy. We had a 5 cents per share. other shipping companies have paid out substantial amounts. We have a lower, let's say, a relatively lower dividend, which is also substantial because the price of the stock was quite lower in the past, and now it has reached 3.7, 3.8 USD, and still this is about 5%. We have designed a dividend policy which is which has a view on two areas. First of all, to reward our shareholders, and the second is to be able to finance our new building program. We are one of the few companies that have, especially public companies that have an extensive program, and we don't want to increase our leverage for that. So gradually, we expect that the stock will go towards its NAV. So it's reasonable to see that the price of the stock will increase sometimes more than the others.
So regarding Newbuilds, you recently acquired a Kamsarmax new build. This adds to an order book of 9 new build vessels you have in the pipeline. I was wondering if you are currently looking for more opportunities to add or remove tonnage in this market. And to add to this, is there a certain age profile you're targeting?
Yes, as we had said in the past, in terms of the new build strategy, we were quite pragmatic. I mean, most of the people said we don't order anything because we don't know what will be the alternative fuels. We feel that the alternative fuels will be available probably at the beginning of next decade, which means that we cannot live with our existing fleet for 10 more years, and which will be about, let's say, we have an average age of 10 years old, and in 10 years from now, it will be 20. I mean, we will not be a shipping company. So we have designed a very careful strategy for that. So we acquired several vessels, which the most important thing is that the average price of such vessels was about is close to 33 million per vessel. They are modern, most of them Japanese dry bulk vessels, phase 3, which means the best efficiency, and a tier 3, which means about the NOx, the best performance for NOx available presently in the market. And at the same time, we have developed also a program for upgrading our existing fleet, because we need to do certain environmental investments to upgrade and be more competitive, because we reduce the fuel consumption on those vessels. And also at the same time, we sold some older vessels, and we can say heavier vessels in terms of consumption, and we bought some younger vessels. The overall, we believe that we will maintain this 10 years old average age, despite the fact that the age, the time is passing, and even in 2025, the average age of our fleet will be about the same. It is important to note that that wherever we find an opportunity at a reasonable price to do something, to buy either a second-hand or a new build, we have done it. And also, if the market permits at reasonable prices, we can sell some older ships. So this is our strategy, which is everlasting. I mean, it continues from time to time, and we do something. It's nothing really spectacular. And also, and we never go in a yard and order 10 ships in a row. We order 1 ship now, 2 ships after 6 months, 1, 2 ships later on. So I think that this new build that we placed is substantially reflects substantially our policy for making orders, which are a limited number of orders from time to time.
So that's a good segue into my next question, because when you're looking towards renewing the fleet and making it more ready for environmental regulations, how do you balance, in one hand, selling older, less efficient vessels, making upgrades to older ships, acquiring modern second-hand vessels, or ordering to renew the fleet? What kind of things are you considering when you decide these things?
Look, we monitor closely the performance of our fleet. I mean, every month we have, let's say, figures for the carbon intensity index, so we know exactly what is happening. And we have, I mean, most of our fleet is very well placed in terms of the new regulation. So if a vessel is a little bit heavier and consumes more, we decide to make an upgrade. And overall, we intend to upgrade about in total 20 vessels by the end of 2023. So these 20 vessels are not, of course, the new builds. They are the ships that we have already, and we upgrade their performance, which means that basically we make them more competitive, and these vessels will be able to obtain better CII characteristics. Of course, the time passes, and these vessels will never, I mean, we will not be able to compete after 2030, but they are already existing. Maybe their average age is about 10 years old, so they will be quite old in 2030. So I think that we are doing let's say, a medium measure for such vessels that will prolong their life and make them competitive and energy efficient. Until new builds will come in our books. And of course, at the end of the day, we all know that new fuels will appear and we'll be able to go to this direction, but we don't have it yet.
So dry bulk stocks hit a trough in October last year, but since then they have steadily risen, and for most of your peers, they have closed the discount to NAV. Most of the dry bulk stocks that we cover are trading closer to 1x NAV. Safe Bulkers stands out as a stock that is heavily discounted to NAV at around 50% right now on our numbers. But it's not long ago that Safe Bulkers traded at parity to NAV. If you could, can you try to explain why the stock is so heavily discounted to NAV, and what you as management can do and is doing to try to narrow this discount?
Look, we cannot, the market is, of our stock is what it is. The important thing is that we have policies which we think will work during the next periods, because investors will realize that by investing in Safe Bulkers, they are investing in a company which has first low leverage. I mean, we have a leverage of about 35%. We consider it reasonable, comfortable, and that we can live with. We don't increase the leverage because of our new build programs. We maintain in this kind of range, plus or minus. And so we direct free cash flows towards the new builds. We have liquidity, so the company has substantial liquidity, more than 100 million. We have in place several facilities to support our future actions. So if something needs to be done, we can do it, and this will give us opportunities to be flexible, because when we decide, or we have an opportunity to buy a vessel, we can do it very, very quickly. And we have a company that has one of the best managements out there. I'm saying that because not because we are the managers, but because it is recognized by our charters. We cooperate not with minor charters, with the largest charters worldwide, and they want to cooperate with us because we have, let's say, the right maintenance, the right approach. We are hands-on. So we have a dividend policy which is decent. It's not the best or the most spectacular one, but if someone wants to invest not only for a few days, but for a longer period in one company, he will realize that this company is renewing its fleet. And in 2025, about half of its fleet will consist of either eco ships built up to 2014, the so-called eco ships at that time, which had also substantially better consumptions compared to the past generation ships. And in 2025, we have also 12 more phase 3 vessels, which have even better efficiency, and the other fleet will be renewed. We have scrubbers in place that are bringing money to us through the differential. We install scrubbers even now in the heaviest vessels in our capes. All our vessels will be equipped. All our capes will be equipped with scrubbers. So why shouldn't someone try to invest in such a company with a strong balance sheet, a strong performance of management, the history of the Hagioannou family? I mean, our CEO has about 40% of the stock, so the interests are aligned. So we're trying to do the best of, and I think that this will be realized gradually by our investors.
So further to this discussion, I think it's relevant to talk about contract strategy, because based on your current vessel employments, it seems you have a mix of long-term fixed rate contracts and spot voyages. Can you talk about how you design contract tactics, how you think you have benefited from this historically, and particularly in the current market with rates on the bit weak side, and a lot of optimism for the future?
Yes, look, I mean, we designed this strategy. We try to make, if we feel that the market will correct in the future, I mean, as we felt for capes, we did, and we managed to basically charter all our capes in period time charters for about 3 years. I think that the average charter hire is about 20,000 when the market is, let's say, 13. And so this brings contract revenue in a bad market for the capes, while if we have them in the spot market, it could be substantially lower. So it's about 160 million, which was contracted in this business of capes. So I think we are successful. In the medium-sized categories, we can do a longer period if it's reasonable. So we wait and see. I mean, if the market is very low, we don't do it because there's no point to book a vessel for a longer period if the market is very low. If the vessel is profitable, then you can do such a chartering strategy. Sometimes if we feel uncomfortable, we make it. We make a charter hire related to the Panamax Baltic Dry Index, which gives us, I mean, it would be lower right now, but maybe it will be corrected in the future upwards. So when this vessel is, when the market improves. So we have a good overall strategy, I think, and this is shown by our financial results of the year, which were not basically affected from 2022, despite the fact that the last part of the year the market was correcting. But we managed to maintain this performance, or approximately the same performance, and about the same performance, and the same revenues, more or less. We have a substantial amount of contracted revenues. And this gives us also a flexibility, because we shouldn't look only to our liquidity. We should also look at what we have contracted out, and the important thing is that with whom we have contracted out. So all these companies that we have contracted for longer period time charters are prime charter companies, chartering companies, and we know that they will perform even if the market is correct.
So regarding scrubbers again, recent spreads have made scrubbers very attractive investments, but maybe the current fuel curve indicates that you're not going to get the same type of returns from scrubbers as you have in recent times. Can you talk about the current arguments US management consider for or against scrubbers, and if you're planning to increase your scrubber exposure going forward?
Yeah, look, we've said back in the past that we are doing half and half. So half of the fleet was equipped with scrubbers and half was not equipped with scrubbers. Of course, this has to do also with the age of the fleet. We are not going to put a scrubber in an older vessel. And of course, it has to do with the efficiency of the ship. So a vessel that is consumed more, it's more reasonable to put a scrubber, while the vessel that is very efficient, let's say an eco ship, does not need a scrubber because it can compete on the basis of its fuel efficiency. Now, we decided to install some additional scrubbers in our capes and to cover all our capes. And basically, by just early 2024, all our capes will be equipped with scrubbers. Why? Because we have this price differential. We know that Mediterranean Sea will be an ECA area shortly, and you need about 8-9 days to make this passage. So the interest for scrubber-fitted vessels is important. Another important factor is that our scrubbers are designed not for 0.5% SOx emissions, but for less than 0.1 SOx emissions. So they are operational through ECA areas without any problem. And this gives us an additional advantage, because if you have 0.5, you cannot use a scrubber during the ECA passage. But if you have 0.1 and less, then you can use this for ECA passage, and this is what we are doing. And this gives us more profits because the price differential between MGO and high sulfur fuel oil is larger than HFO and low sulfur fuel oil.
So I think we're turning to my last question, which is a bit of an open question. Is there anything you're looking forward to in terms of major challenges or opportunities, firstly in the coming months and then in the coming years? And how do you think Safe Bulkers is best placed to address these?
Look, I think I said it. I said most of the things during the previous questions that you did, so I may be repetitive during the last question. So I think that what we try to do in this in the previous years that we had a good market, what we try to do is to, first of all, to deleverage the company. And we did it because we reduced the leverage. In the actual numbers, about $200 million, we did this reduction. The second thing that we did is to reduce, to maintain steady, or to reduce the interest expense, relatively interest, because we know that interest rates are going up. And what we did was the issuance in the Athens Stock Exchange of a €100 million bond with 2.95% coupon, steady coupon, unsecured bond. The coupon is steady, so basically 25% of our debt is for 5 years. The interest will not change, it's steady. We try to make a strategy for renewing our fleet, for putting new vessels, for competing on the basis of energy efficiency and new environmental regulations, for improving our existing fleet. We maintain very low, high liquidity to be flexible. We low leverage, comfortable leverage, as we said. So I think that this is a story that as we move ahead will be distinct from the other peers in the market, and that we somehow be able to attract more attention for investors of what we have done in the past. This is more or less what we are thinking. Of course, the important thing is the markets. We pray that this war will, in between the attack of Russia against Ukraine, will somehow, at certain point of time, will finish, and which will be a good boost for the global economy, and also that the inflation will be somehow reduced. So the interest rate will not continue to go up, but will be stabilized and go towards lower levels, which will improve the global economy, will improve the trade. So if this happens, at certain point of time in our life will happen, maybe 1 year, half a year, 2 years, Safe Bulkers will be a fleet, a company with a young fleet, about, again, 10 years old, with half of it very modern, very efficient, the other half environmentally upgraded with low leverage, and will be one of the best companies in the public markets. This is what we believe, and we do it for our shareholders. One of them is our CEO, Polys Hadjianou, who, of course, wants to see his wealth, which is basically invested through safe markets, to increase, but we cannot do anything more than that, but to perform.
Great. I think this wraps up our discussion. Thank you, Loukas, for taking the time to speak with us today.
All the best.
Please.
Yes, all the best, and to all the people that are hearing us.
Please note that this discussion will soon be made available on Capital Link's website at www.capitallink.com and YouTube channel. Thank you.
Thank you.